think, free, when you put it free, you have to put quotations around that, the air marks around it, because it is free for the retail investor, absolutely. And I think if you're trading occasionally 100 shares here and there, that's not going to, it's wonderful. You just save $5 and put it in your pocket. But for a more active trader, that becomes a little bit more of an issue as to where are these trades going to go. And this is where I take issue with it, because the online broker doesn't, they are still making money off of the trade, because most of them do sell that order flow to market makers. And this is all public knowledge. You can look at what they call a 606 report and see exactly where is Schwab sending their flow for the last quarter and how much are they getting paid for that flow. So the question then becomes is there a conflict of interest in how the orders are being routed and where they're going? And that's been a debate on Wall Street for years now, guys. And we've been talking about payment for order flow in general. The exchanges do it as well. They pay rebates for order flow. Market makers pay for order flow. Everybody wants to see the order flow. So it is an issue. It's been, this will only make it worse because more trades will now be directed to market makers. So, we'll see. But in our opinion, it is not the best for the market when orders are being siphoned off and not making it to the public limit books.
So can you explain a little bit more about why you think it's going to make it worse? And for, let's say you're not, a professional trader, but you are in the markets a little bit. Do you worry more that people aren't going to be getting the best execution on their price as this system is exacerbated?
Well, brokers do have an obligation. We all are under the obligation of Best X, and it is monitored by FINRA as well as the SEC. So if a broker is doing something and you feel that your broker is not routing it and you're getting a poor execution, I recommend, either calling FINRA up or one of the regulators and letting them know that. Because brokers, like I said, they have a Best X obligation. But, one of my problems is that I think what's happening is that the order flow on the book is becoming less diverse. When I say the book, just in general, all market orders coming together. It used to be, institutional orders would interact with retail orders, would interact with market maker orders, would interact with high-speed orders, and now a lot of that is being siphoned off before it ever makes it to the market. So how does that help or hurt price discovery is an open issue that people are still talking about. Should this flow be directed into a, let's just say, for instance, I'm placing a limit order to sell, and someone wants to buy my stock. Well, that could get intercepted by a market maker because the retail broker is selling that order flow to the market maker when, in fact, I was the one who set the price. I displayed the price. In other words, somebody who's putting out better prices, being responsible for price discovery, is going to get hurt here. That's the opposite side of this argument. That's the opportunity cost that's being lost by the displayed limit order who's trying to do the right thing and tighten up a spread, but in fact it's going to get intercepted by a market maker. So, these are all questions on Wall Street, and the SEC has known about this. There's been numerous academic papers written about this. It's outstanding. So today, it doesn't shock me that Schwab went to free. As some of your commentators already noted, other brokers have done it. It's just the way it is, but it doesn't make it right.
Hey, Joe, Brian Chung here. So I think it's important that we're kind of highlighting the nuance of this issue here. But when we talk about, these companies, they are still going to make money off of this, right? I mean, it's not like this is a money-losing operation for them. But still, you beg the question based on the stock reaction. You have Schwab down, pretty substantially. E-Trade also crashing today. I mean, questions about who is then taking some of the cut from here, right? And you were mentioning kind of this in the pipeline that you were just laying out, that, companies like Citadel, for example, could be jumping in the order here. So, I mean, is it those firms that are really benefiting from the no-cost structure that seemed to take over the industry, at least today?
Well, order flow is the lifeblood of most firms, right? Everybody wants to see as much order flow as possible. So, yeah, if they can see more order flow, it's going to benefit them. It's going to model their model could now change or be even that much more accurate as to where the market's going, because, they want to see as much as they can to predict, not necessarily about that one trade, but more about the market in general. If they see a whole bunch of retail orders coming in, well, maybe that's indicating something and so on, depending on where the model is. But, the online brokers will lose a little bit, and it's public knowledge, I guess, as to how much they're getting commission-wise, but they are still getting paid from the payment for order flow. They are still making interest margins on the cash balances that are out there. They are still making advisory fees. So they still have a model. It just seems like this is one piece that will be taken from it, and maybe they'll make it up. I'm not an analyst. I don't really comment on their particular names, but maybe they'll make it up somewhere else. But in general, what does it do for the order flow? Yeah, it's going to benefit the bigger market makers who can see more of it now.